Welcome to my channel Commerce Specialist, where you will find up-to-date and important videos covering different learning outcomes of various academic and professional qualifications. Ladies and gentlemen, today's topic is accounting for receivables. You can call it accounting for debtors, accounting for receivables. So the very first thing we need to know is, what are receivables? Look, when we sell goods on credit, when we sell goods on account, that means we are selling our goods and customers are not paying us. We call that receivables, amount which the customer owes us. So when we sell goods on credit, receivables are generated. Receivables are our current assets. And obviously, if the customer has not paid us, there is no guarantee when they will pay and how much they will pay. So there is uncertainty relating to the timing of cash collection. There is uncertainty relating to the amount of cash collection. And we have an important accounting concept. We call it Prudence Concept. Another name for Prudence Concept is principle of conservatism. And principle of conservatism or Prudence Concept tells us that future losses are to be immediately recorded. And ladies and gentlemen, the amount which we are unable to recover from customers, we call it bad debts. And bad debts is a potential loss. Bad debts is an operating expense. So here comes another accounting concept, the matching principle. The matching principle says that in order to calculate correct profit and loss for a particular accounting period, all incomes, expenses and costs for that particular period are to be taken into account. And let me tell you, bad debts is one of the operating expenses which we need to take into account. Now the next question is, how to estimate bad debts? Bad debts is that part of receivable which we are unable to collect from the customers. The question is, how to calculate bad debts? How to estimate bad debts? So we have two different approaches, the income statement approach and the balance sheet approach. Under the income statement approach, bad debts are estimated at a certain percentage of total sales. Whereas in the balance sheet approach, bad debts are estimated as a certain percentage of account receivable. So ladies and gentlemen, in today's video, I'm going to cover both the approaches, the balance sheet approach, the income statement approach. I'm going to cover how bad debts are calculated, what is the adjusting entry for bad debts, what are the general entries which affect receivables and bad debts, how to make ledger accounts of account receivable and bad debts, and the financial statement extracts. To be more precise, balance sheet or statement of financial position extracts. So ladies and gentlemen, today's video is going to be very, very interesting and valuable for you, especially if you are, accounting and finance students. So let's begin with a numerical example which makes your concepts more clear. I have a small question here, a basic one, which helps us understand how bad debts are calculated under the two different approaches, which is the income statement and the balance sheet approach. Data is given here. If you look at account receivable, year-end balance is already given to us, which is 100,000. Total sales is also given to us, which is 1 million. And the requirement which is given, that is very important. It says calculate bad debts expense and give adjusting entry assuming the company estimates bad debts at 10% of year-end account receivable balance. Now this 10% of year-end account receivable means that the company is estimating bad debts as a percentage of receivables, a year-end balance of receivables. So if the bad debts are estimated at year-end balance of receivable, we call it balance sheet approach. And there are certain assumptions here. They say under the following assumptions. There are 4 assumptions, A, B, C and D. And assumptions are about allowance for bad debts balance. I will tell you what is allowance for bad debts balance. For now, look at the assumptions. Assumption A says that the allowance for bad debts account has a 0 balance before adjustment. So what does this mean? Let's have a look. If I'm talking about the first case, the first scenario, this one, A, I am calculating bad debts based on a certain percentage of year-end receivable balance. So this is how we start our calculation. First of all, we write account receivable. I'm using short form to save time. Account receivable year-end balance given in the question as 100,000. Just drop a line here so that you don't add this 100,000 into any other amount. This is just to show that year-end account receivable is 100,000. Then look at the company's policy. Company calculate bad debts at 10% of year-end account receivable balance. So I can write here bad debts, estimated bad debts. It is pronounced as bad debts. The B is silent here. So bad debts estimated at the rate of 10%. Now 10% of 100,000 is 10,000. Because bad debts are calculated on year-end account receivable, so we have to look at what is the balance of allowance for bad debts. So in first scenario A, it says allowance for bad debts has a zero balance before adjustment. So there is no balance, which means this same 10,000, I'm just writing it down again, 10,000 is my bad debts expense. Bad debt expense for the year. And what are adjusting entries? There are certain adjustments to be made at the end of the year. Bad debts is one of them. So the adjusting entry is like this. It's very simple. I'm giving the short form adjusting entry. We debit bad debt expense and we credit allowance for bad debts. With this amount, 10,000. So, in different books, by different authors, they use different terms. The most common is bad debt expense debit, allowance for bad debts credit. You can also call it uncollectible accounts expense debit and provision for bad debts credit. Now let's look at the same question, but the second assumption. In the second assumption here it says the allowance for bad debt account has a credit balance of 4,000. What do we do? The calculation is very simple. If you have a look at this, this is case B. The question is the same, company's policy is the same. So I am taking account receivable year-end balance, same as before, 100,000. Drop a line here so that you don't add it with something. Look at company's policy, bad debts at 10%. So I am writing here bad debts estimated at the rate of 10%. 10% of 100,000 is 10,000. Now it is very important, whenever bad debts are estimated at 10% of year-end account receivable balance, we have to look at the allowance for bad debts balance. And in assumption B here, it has a credit balance of 4,000 before adjustment. Please understand, whenever there is a credit balance of allowance, that is to be subtracted from this figure. So I am writing here less existing credit balance of allowance for bad debts. Short form I'm using because of space constraint. So the credit balance of 4,000 will be subtracted from this 10,000, and this 6,000 will be my bad debt expense for the year. With this amount I will give my adjusting entry, and adjusting entry most of the time is the same. Bad debt expense debit, allowance for bad debts credit. So bad debt expense debit and allowance for bad debts credit with 6,000, not 10,000, 6,000. Ladies and gentlemen, now we need to understand why did I subtract this 4,000 credit balance of allowance? We need to know that the entire process of estimating bad debts is just, an estimation. It's not real figures. So at the end of every year, whatever is our outstanding receivables, the amount which we have to receive from customers, we just estimate an amount based on our past experiences. Let's say 10%. But it's not necessary that exactly 10% of the amount will go bad. It can be more or less. So if an allowance for bad debt account has a credit balance of 4,000, that means in the previous year, bad debts were overestimated by 4,000. So if it were overestimated, we are subtracting this 4,000 from current year estimation to adjust it. On the contrary, if the bad debts have a debit balance here in part C, if you look at, bad debts have a debit balance. What does this debit balance in allowance for bad debts show? It shows that the last year bad debts were underestimated. That's why if we had a debit balance here, I would have added it. So if I'm talking about C, I start off with, account receivable year-end balance. Account receivable year-end balance is given here, very straightforward, 100,000. So I'm writing here account receivable year-end balance. Okay, I'm using short form just to save time. 100,000. Don't forget to drop a line here. Look at the policy. What is company's policy? Company's policy is 10% of year-end balance. That's the bad debts they are estimating. So I'm writing here bad debts at the rate of 10% of this amount. It comes to 10,000. Now at this point, as I said earlier, we need to be very, very careful. Once a 10% or 5%, 15%, whatever is calculated for the year-end balance, we have to look at, is there any balance in the allowance for bad debts account? Yes, it has a debit balance of 2,000. A debit balance of 2,000 means in the previous year it has been underestimated. Less bad debts were recorded last year. So we are going to adjust it here now. Add debit balance of allowance for bad debts, which is 2,000. So my bad debt expense for the year will be 12,000. This is my bad debts expense. This amount 12,000 will go in the profit and loss account among expenses: salaries, rent, insurance, depreciation, bad debt expense of 12,000. The adjusting entry will be like this: bad debt expense debit and allowance for bad debts with this 12,000 credit. Now assumption D is very interesting. If you look at assumption D, it says bad debts has a credit balance of 14,000 before adjustment. So what we are going to do? Same steps. The initial steps are repetition, so I'm doing it a little quickly. D, we write account receivable year-end balance. Same as the question, because the question is the same, assumptions are different. 100,000. Bad debts, the company policy is not changing. Bad debts are calculated at 10%. So 10% of this would be 10,000. Now you got to be very careful. So if you look at case D, assumption D, it says it has a credit balance of 14,000. A credit balance in allowance, as I already told you, that means last year it was overestimated. So it was overestimated last year. Now we have to subtract it. So I will write less credit balance of allowance for bad debts. So the credit balance is 12,000. So from 10, when you multiply minus 12, you will get a minus of 2,000. 10,000 is your estimated bad debts. You minus your credit balance of allowance. 10 minus 12 will give you minus 2,000. We will call it decrease in allowance for bad debts. Whenever you have a negative bad debts for the year, the adjusting entry will be different. Every time we give an entry, bad debt expense debit, allowance for bad debts credit. If you look at in assumption C, we had 12,000 positive. Positive mean it's an expense. So we debited expense, bad debt expense debit. Debiting an expense mean you're increasing your expenses. That will go as a expense in your profit and loss account. But here it's a negative. That means your expenses are decreasing. So the adjusting entry would be like this. We debit allowance for bad debts by 2,000 and we credit retained earnings of 2,000. Crediting retained earning means I am, increasing my accumulated profits. Because bad debts were overestimated last time, so this time I have to adjust my retained earnings. Ladies and gentlemen, I hope you have understood how bad debts are calculated under balance sheet approach. Balance sheet approach means when bad debts are estimated as a certain percentage of year-end account receivable. What we do is, we look at the year-end account receivable, look at the company's policy, whether it is 10%, 20%, we calculate 10 or 20% of the year-end account receivable, then we do look at what is allowance for bad debts balance. If it's a credit balance, we minus. If it's a debit balance, we add. But in any case, after adjusting allowance for bad debts, if we have a negative final amount, the adjusting entry would be like this. We debit allowance and we credit retained earning. If we have a positive amount after adjusting allowance for bad debts, the entry is pretty simple. Bad debt expense debit, allowance for bad debts credit. Now next, we are looking at what if the company estimate bad debts as a certain percentage of sales. If it's a certain percentage of sales, we call it income statement approach. And if you look at here, in part 2, it says, the question is the same, but calculate bad debts if the company estimates bad debts at a certain percentage, 1% of sales. Estimating bad debts on a percentage of sales is known as income statement approach. The calculations are a little different. Have a look at it. I am talking about case 2. Whether I look at assumption A, B, C or D, it doesn't matter. Why? Because when we are talking about income statement approach, we are not looking at allowance for bad debts balance, whether it is debit or credit. The calculation under income statement approach is different. So we look at sales for the year is given in the question as 1 million. Drop a line. So we have sales of 1 million. As per policy, bad debts are calculated 1% of total sales. So bad debts at the rate of 1%. 1% of 1 million will be 10,000. And this is my bad debts. I will not look at whether allowance for bad debts has a debit or credit balance or whatever. So when we're talking about income statement approach, in income statement approach, we are estimating bad debts as a certain percentage of sales. And when we're talking about sales, allowance for bad debts does not go into the statement of comprehensive income, or you call it income statement. So it's pretty simple. Just work out a percentage of sales. Whatever it comes, give the adjusting entry with that. Adjusting entry would be bad debt expense debit and allowance for bad debts credit, which is 10,000. Same will be the case for B, C and D, because under income statement approach, we do not adjust the allowance for bad debts balance. So guys, this was about the two approaches calculating bad debts. One, estimating it at a certain percentage of year-end receivable balance, the other as a certain percentage of total sales. Next, we are talking about the journal entries. Various transactions relating to receivables and bad debts, the ledger accounts, adjusting entry, and the financial statement presentation. So guys, the next step in accounting for receivables is we need to know how to record transactions relating to receivables. We need to know how to prepare the relevant ledger accounts, obviously estimating bad debts, and the statement of financial position, or you call it balance sheet extracts. So here I have written a small question, a simple one, to develop a basic understanding. If you look at the question, it says account receivable balance on January 1st, 2019, it's 140,000, and allowance for bad debts balance at the same date is 10,000. Here you need to understand the accounting basics. If nothing is said, account receivable being an asset would normally have a debit balance. So it's not necessary we write account receivable opening balance debit. No, it's understood. Unless it's a credit balance, that would be mentioned. Allowance for bad debts, all allowances are contra asset account. Normal balance of an asset is a debit, so normal balance of an allowance for bad debts or provision for bad debt account would be a credit, as in this case. It says allowance for bad debts balance on January 1st, 10,000. It's not mentioned whether it's debit or credit, so it's understood generally it's a credit balance. So these are opening balances, and then comes transactions during the year. Certain events took place, certain business dealings took place, activity took place relating to receivable, sales, cash collection, so on and so forth. And in the end, they are telling us the company estimates bad debts at the rate of 10% of year-end account receivable balance. Now, year-end means we are given opening balances, and there are certain transactions. Obviously, if there is an opening balance and after that subsequently there are transactions, it will disturb the opening balance. And as a matter of policy, we have to calculate bad debts at the year-end balance, not the opening balance. So first, let's have a look at the entries and how do they affect receivables. The very first entry, it says sold goods on credit. So I'm giving the entry here. Selling goods on credit means you're selling the customers your goods, your merchandise, your stock, whatever you're dealing in. Selling on credit or selling it on account means you're selling but the customer is not paying you. If the customer is not paying you, that means you have to receive. So this is how it is recorded. We debit account receivable and we credit sales. The first amount is 600,000. Now, if you ask me why did I debit receivable? Receivables are our current assets. As soon as we make a credit sales, receivables are generated, current assets are increased. An increase in an asset as per the rules of debit and credit is a debit, so I've debited account receivable. Crediting sales means increase in income. As per the rules of debit and credit, when the income increases, I credit. So I have recorded account receivable debit, sales credit. Coming to the second one, sales discount. It is also known as discount allowed. When we give discount to the customers, you call it sale discount or discount allowed. The double entry is like this. You debit sales discount because it's an increase in expense. How much? 7,000. And you credit your account receivable, 7,000. Obviously, if you're giving a discount, that portion of the money will not be received. So whenever we give a discount, it reduces our receivable. Receivable is an asset, decrease in an asset is a credit. So as a result of discount, your receivables are reduced, your assets are reduced. Third transaction says sales return. Sales return means when we sold goods, after some time, some of the customers may return the goods. They may be defective or XYZ reasons. So when customers return goods, what entry do we give? We debit sales returns and credit account receivable. By how much? 9,000. Now another name used for sales return is return inwards. Returns inwards coming in, that means customers are returning it. When we return, it's return outward, or we call it purchase returns. So what you need to remember is whether it be a sales return or a sale discount, account receivable is credited. That reduces your receivable. Obviously, if I've sold goods worth 10,000 to customer A, I have to receive 10,000. But if customer A has returned goods worth 2,000, how much do I have to receive now? 10 minus 2, 8,000. Therefore, sales return or return inwards always reduces our receivable. Receivable being an asset, a decrease in an asset is a credit, I have credited it. Transaction number 4. Customer's account written off. Now, what is writing off customer's account? We write off customer's account, those balances which we are unable to collect. But that does not mean we just write it off like that only. Companies follow their policies and procedures. Calling the customers, going to the customer's office, calling him, going to his house, trying all their level best. But a point comes when the company realizes that, let's say the amount receivable from customer is 10,000 and the amount which we have spent to recover the money is coming very close to it. So the cost of collecting receivable is about to go higher than the cost of receivable itself. So what the company does? The company writes off the account. Writing off the customer's account means that, okay, now we are no more working on it. It's closed in our books. Generally, the entry to write off an account is like this. We debit allowance for bad debts and we credit account receivable. Crediting account receivable means we are no longer chasing this customer. And debiting allowance for bad debts, I'll tell you why I'm debiting allowance for bad debts. Understand, generally when we record bad debts, the entry is bad debt expense debit, allowance for bad debts credit. Now, debit to expense, all expenses are closed into profit and loss. So when we give the adjusting entry, bad debt expense debit, allowance for bad debts credit, bad debt expense debit is closed into profit and loss, allowance for bad debts is still there, active. And when we know that this customer is like, we have nothing to do with the customer, we cannot get the money, so why have that allowance for bad debts as a credit balance? To close allowance for bad debts, I am debiting it here. Bad debt expense related to that customer is already, closed into profit and loss. So what you need to remember is, when we write off a customer's account and we already have an allowance for bad debts balance, writing it off through allowance for bad debts is this entry. Allowance for bad debts debit, account receivable credit. Sometimes some companies do not maintain allowance for bad debts. In that case, it would be a direct write-off. A direct write-off is we debit bad debt expense and credit receivables. We do not include, debit allowance for bad debts in that case. But here, very much we are maintaining allowance for bad debts, so we cannot go for a direct write-off unless the question tells you it's a direct write-off. So if it's a direct write-off, debit bad debt expense and credit account receivable. Here, it's not a direct write-off; it's a write-off through allowance for bad debts. So allowance for bad debt debit, account receivable credit. Entry number 5 is cash collections. Now, entry number 5, you can simply connect it with this entry. In entry number 1, when we sold goods on credit, the entry was account receivable debit, sales credit. Debiting account receivable means we have to receive money. And now in entry number 5, you are collecting the money. You're collecting how much? You're collecting 50,000. So if you're collecting money, cash is coming into the business, cash is an asset, cash debit, 50,000. And you credit account receivable. Now, crediting account receivable, when you sell, you debit receivable. That means you have to receive. When money received, you credit account receivable. So here, if you look at in terms of debit and credit, one asset is increasing, cash is coming in, you debit cash, increase in asset is a debit. The other asset is decreasing, account receivable, you credit that. Now, entry number 6 is very interesting. It says recovery of a previously written off account of 20,000 to the extent of 15. That means there was a customer who, from whom you have to receive 20,000. You tried your best. That customer never showed up, did not pay, so you wrote off his account. After some time, the customer appears and he says, okay, take your money. So we are not going to tell the customer, look, we have closed your accounts, we have written it off, so we don't need the money. No, we do receive. But what do we do now? Because the account was closed earlier, now we have to reopen. The technical word is reinstatement. An account has been written off earlier. If the customer, comes out of the blue and pays you, we are not going to, refuse him. Yes, we are going to collect our money. But for that, first we have to open the account, reinstate the account, and then collect the money. So for entry number 6, there will be 2 entries. First for reinstatement, second for cash collection. So I am writing it as 6A. Look, when you write off the account, if you look at number 4, it's allowance for bad debts debit, account receivable credit. This is how you write off. When you reinstate, that's just the opposite. So I'm going to debit account receivable here and credit allowance for bad debts. Now here normally students make a mistake. They reinstate the account with 20,000. No way. Don't forget, it's the same customer who made you run from pillar to post for the money, but you were unable to recover. So whatever is coming now, just be happy with that. So you give both the entries with 15,000. Whatever you're collecting now, open the account with that amount and collect the money. The remaining stays as written off, unless the customer pays. So we reinstate the account receivable debit, allowance for bad debts credit with 15,000. In the first entry, that's reinstatement, opening the account, and 6B is collecting the cash. So when we collect cash, is cash debit and account receivable credit, same amount. Some people prefer to, combine this entry, because if you look at in 6A, receivable is a debit and allowance for bad debts is a credit. In 6B, cash is debit, receivable is credit. So if you look at this, receivable is debited and credited. Debit and credit is like plus and minus, it cancels out. So what is left? Cash debit, allowance for bad debts credit. So if you give one entry for this, that's also okay. The entry would be cash debit, allowance for bad debts credit. I prefer to give 2 entries, one for reinstatement, the other for cash collection. Now ladies and gentlemen, all the entries have been recorded. As I told you in the beginning of the question, that this account receivable balance, if nothing is said, it's a debit, and this balance is a credit. Now in accounting, we follow a rule, a debit and debit is always added. So if you have an opening balance of debit 140,000, and in the very first entry, you're debiting it again 600, debit and debit is added. So that means the balance is changed. Likewise, if account receivable is a credit, you minus. So what I'm trying to tell you is, when we have opening balances and we have transactions which affects the receivable, we need to find out the closing balance. Because the company is calculating bad debts at the year-end balance, not at the opening balance. So this first part is over. We have given all the entries. Now what I'm going to do is, I'm going to erase this part, go for ledger accounts and bad debts calculation and adjusting entry. Now we know that in the question, the opening balance of account receivable was 140,000 debit. So the only 2 ledger accounts which are relevant in this question is the ledger account, the T account for account receivable and allowance for bad debts. That's it. So if I prepare a ledger account for account receivable, it looks like this. All assets generally have an open balance on the debit side. That's the normal balance of an asset account. So 2019, January 1st, balance brought down. That's how you write the opening balance, 140,000. That's the first thing you do. By the way, you can also have a credit balance in accounts receivable. That's only in case if a customer has done overpayment or advance payment to you. Now, once I've recorded the opening balance, I'm looking at the entries. Please remember, I'm talking about account receivable. So my focus is only on account receivable being either debited or credited in the entries. So in the first entry, it's a debit of 600,000. I'm writing here first entry, debit of 600,000. In the second entry, it's a credit of 7,000. In the second entry, it's a credit of 7,000. In the third entry, it's again a credit of 9,000. So in the third entry, it's a credit of 9,000. In the fourth entry, it's a credit of 30,000 again. Fourth entry, it's a credit of 30,000 again. Fifth entry, cash debit receivable credit, it's a credit of 50,000 again. In 6A, it's a debit of 15, and in 6B, it's a credit of 15. So 6A, it's a debit of 15,000, and 6B, it's a credit of 15,000. Now what I need to do is, I need to do the totals. So if I look at the debit side, 140, 600, and 15,000. So that will be 600, 740, 755. The total of this side is 755,000. And if I look at this side, 16, 80, 96, 111. So this is 111,000. Here also there are 3 zeros. So what do I do now? The difference. The higher side minus the lower side. 755 minus 111 will give me 644,000. So always, as a rule of ledger accounts, I find the difference, and the difference is written at the lower side. So I'm writing here December 31st, balance carried down. 755 minus 111,000 will give you 644,000. As soon as I write this, I drop a line here, not over here, but over here. This side total is 755, and 111 and 644 will give you 755. The account's closed. Account receivable account is prepared this way. Right? From the top, putting the opening balance, doing the ledger posting. Ledger posting means if account receivable is a debit, you put it on the debit side. If it's a credit, you put it on the credit side. Once you have put all the debit and credit entries, do the total of debit and credit side, find the difference, and the difference is written at the lower side. Because this side was 755, this was 111, this side was heavier, so the difference I have written at the lower side to balance. This is known as balancing a T account. Now the next important account I need to look at is allowance for bad debts. So I'm preparing another account which is allowance for bad debts. In the question, if you want, you can rewind and check. In the question, allowance for bad debts has an opening balance of 10,000. And nothing was said, nothing was mentioned whether it's a debit or credit. So we assume it's a credit balance. Because all allowances, all provisions normally have a credit balance. So I'm writing here January 1st, 2019, balance brought down 10,000 on the credit side. After this, let's look at the entries one by one. Because I'm making a T account of allowance for bad debts, I'm only interested now in allowance for bad debts, whether being debited or credited in the entries. So in the first entry, there is no allowance for bad debts. Second entry, there is no allowance for bad debts. Third entry, there is nothing. Fourth, allowance for bad debts is a debit with 30,000. So I'm coming here on the debit side. Fourth, it's a debit of 30,000. In the fifth entry, there is no allowance for bad debts. In the sixth, there is a credit of 15,000, which is 6A. 6A, it's a credit of 15,000. And that's it. Ladies and gentlemen, this is the most important point. Many students I have seen, because I've told you in my very first video in my introduction that I've been teaching for the last 24 years to ACCA, CA, CMA, CPAs, BCom, A&O levels, and all these qualifications I have found when students are doing receivables, they make a mistake here. I don't want you to make the mistake now. Once I've recorded the opening balance, I've put the entries from here, the journal entries posted here. Now I need to know what is the balance of this account as of now. I'm not closing the account. So on the debit side, it's very clear that it's 30,000. On the credit side, I have just two amounts. If I add this, that comes to 25,000. So now you need to know something important. There is something known as existing balance of allowance for bad debts. What do we mean by existing balance? This is what we mean by existing balance. At the moment I have 30 here and 25 here if I add these two. Which side is greater and by how much? Debit side is 30, credit side is 25. So the debit side is greater by 5,000. If the debit side is greater by 5,000, so that's an existing balance. So I'm just writing here to make you understand. At the moment, this T accounts, debit side is 30, credit is 25. So the debit is greater by 5. So I'm writing here it has a debit balance of 5,000. Okay? Why? Because the debit side is 30, this is 25. So debit side is greater by 5, so it has a debit balance of 5. We call it existing balance. And why am I emphasizing so much? This is the same debit balance when we estimate bad debts. Either we have to plus or minus. If there's a debit, we add. If it's a credit balance, we minus. This is the amount how we calculate. So I'm not closing this T account. I'm going to calculation of bad debts. Account receivable, year-end balance, which we have just calculated here, 644,000. Drop a line here. Company's policy in the question, you can rewind and check if you want. It was estimating bad debts at 10% of year-end balance. We already have year-end balance thanks to the T account. Now, bad debts at the rate of 10% of this amount, which will give you 64,400. Now, because the company's policy is estimating bad debts at 10% of account receivable, 10% of account receivable is 64,400, we have to look at the existing balance of allowance for bad debts, which we have just calculated. Debit side is greater, so it's a debit balance of 5. So I'm going to write here, add existing debit balance of allowance for bad debts, which is 5. Okay, so this will give me 69,400. 69,400. This is my bad debt expense for the year. Bad debt expense for the year means with this amount I'm going to give my adjusting entry, and this amount is going to go among the operating expenses as one of the expense. So the adjusting entry will be, I'm giving the entry here, adjusting entry. Obviously adjustments are normally done at the end of the year, December 31st, 2019. Bad debt expense debit. And allowance for bad debts credit, which happens to be, which is 69,400. 69,400. Adjusting entry given. Now you'll be wondering, I have closed this account. Look, I have done the balance carried down, closed it. But this account is still open. You know why? Because I knew when I'll give the adjusting entry, allowance for bad debts will be credited. And I already have allowance for bad debts account. So this adjusting entry is to be posted here in the T account for allowance for bad debts at December 31st. December 31st. If you want, you can, just to understand, I'm writing here adjusting entry. This is just to make you understand. How much allowance for bad debt is credited by 69,400. So I'm putting here 69,400. So when you add this, you will get 94,400. From 94,400, when you minus 30, you will get the closing balance, December 31st, balance carried down. That will come to 64,400. 94,400. Ladies and gentlemen, The two ledger accounts are complete now. Bad debts have been calculated. Adjusting entry has been given. The last part is the extract for statement of financial position, or in layman's word we call it balance sheet extract. Remember, when we talk about extract, we are not making the whole statement of financial position. We are not making the whole balance sheet. We are only talking about a snapshot, one part of the balance sheet which relates to receivables. Let's have a look at it. Obviously, you have assets. Account receivables comes under current assets. I will write account receivable. What balance do I take? Not the opening, the closing balance, the year-end balance, which we have calculated here. 644,000. So I write 644,000. In the statement of financial position, among assets, under current assets, there are so many assets: cash, bank, closing stock. We also have receivables. Receivables mean the closing balance of receivable that we got from here, from the ledger account of receivable, and then less allowance for bad debts. Which balance? The closing balance, which is here, after giving the adjusting entry, which is 64,400. Subtract whatever comes, you write it here, and that's it. That's the, balance sheet extracts. So ladies and gentlemen, it was all about accounting for receivables, the two different approaches used to calculate bad debts, the balance sheet approach, the income statement approach, the ledger entries, the adjusting entries, the ledger accounts, the statement of financial position extracts. So ladies and gentlemen, if you like the content, please subscribe to my channel, press the bell icon button so that you get all the important and relevant videos on a timely basis. I'll see you next time with a very important and interesting topic. Thank you so much for your precious time.